Okay. All right. Thank you, Rock. That's pretty interesting with what's going on with the S&P 500 right now and those 6 major tech companies. A little bit eye-opening there. When we're looking at the second quarter GDP, most of you have heard in the news that it was a pretty nasty looking quarter. The overall GDP was down almost 33%. I mean, that's just a huge number. And the 4 biggest drivers on here are the government, which was actually positive, investments into the country, which was down 9.4, and then consumer consumption, ultimately was down -25. Everybody was kind of shut in. They weren't spending so much. And then the net exports actually boosted up at a 0.7. But all in all, it was a relatively nasty quarter. And I'm sure most people are going to want to just kind of put that behind them. We've talked about the PE ratio in the past. We do it on every one of our shows. So currently we're at 28.23. So we're really on the high side. What does that mean? It means that the stock prices are high, but the earnings are low. And that's kind of represented in what was going on with the GDP. So you've got a major negative number there. Now, what you're seeing is this clear dichotomy between the prices and the earnings, and that will come back in line again. We will be looking at some sort of correction coming down the road. Exactly when, we're not sure. If you think about the pending or potential correction that could be coming down the road, even when we look at the last few months with all the stimulus that has been going into our economy, we showed a chart a couple weeks ago on the halftime report where the stock market came down. They started the stimulus package, and the stimulus packages, as it kept increasing, so did the market. So where are we at today on stimulus? Well, at the end of the day, it looks like we've got another package coming. So we're not exactly sure the timing of it. But if it does come into play in the next couple weeks, which most people expect, we could probably see the stock market move higher once again. Again, potentially putting the PE ratio a little bit out of control here, or further out of control. When you think about the economy, the recovery has been quite uneven overall. This chart shows you some of the areas in the economy. Certain areas are doing very well, others not so well. You can see this chart shows the percent on the left side of gains and losses. On the lower axis, you've got the time frame, and you can tell in the chart the purchases, mortgage applications, initially, and that's the dark blue here, went down, but it has been moving forward. So currently it's at a +15, not so bad. Well, you look at the purple line here, that's the US seated diners. Well, that one dropped dramatically and is not recovering too fast. And part of that is because our country is closed. We started opening up the restaurants. We started opening up the bars. In Michigan, they kind of pulled back a bit. So they actually closed many of the bars back up in different areas. So this is going to be a tough road for those people until we actually get the economy going. You look at TSA travel traffic, again, down 79 right now. That's the lighter blue. So it's not been an even recovery at this point. And it'll take time for those that were hit the hardest to be able to come back. This chart is a kind of an interesting chart because it gives you a little historical reference comparing the size and duration of the US economic recessions we've had. So we've got the blue charts, those are the historical ones, and then we have the gray circle towards the lower right-hand corner where our current recession is at about a 12.8% decline in real GDP. You go back to the Great Recession, that's closer to the upper left-hand corner of the chart, which was down negative 26.7. So dramatically greater than what we're going through today. That one was not self-imposed. The one we're in right now is self-imposed relative to all the shutdowns. So it is going to act dynamically different than what we've seen in the past. If you think about the equity market recoveries, some are longer than others. We just came out of the longest economic bull market in history, only to have to shut down to end it. But what this chart shows you is every single time we have a recession, what happens? We have a pretty good uptick in the market afterwards. So your average bull market afterwards is 279% return. So at the end of the day, this too will pass, and we will get back into another bull market as we move forward. I'm sure everybody would love to see that get started. Maybe it started already. We're not sure yet, but it will happen. So as we look forward, we've talked a lot about what type of recovery this is going to be from an economy standpoint. And we've looked at several different types of recovery. You've got the V shape, the U shape, the W shape. It is looking less and less likely that is going to be a V-shaped recovery. So again, we didn't think that was going to happen because you never know what shoes are going to drop down the road. Things we didn't think about in the economy that had a major bearing that ultimately pulled the market back again. Not to mention the fact our PE ratio is really, really high right now. So that wasn't likely. A U shape is probably more likely, and the W shape is becoming more and more possible, which is more of what we were looking at from the stock market, a W shape as the PE corrects itself down the road here. So we're looking at closer to a U or a W shape in the economy. And for the stock market, again, it's not completely clear yet, but we're thinking it's going to be more like a W shape for the stock market. And that is where we will actually get into some of the strategies that we've already got set up, but have yet to implement for our clients. So where are we today? I talked a little bit in the past about the gap down initially when the stock market first started hearing the news. We had a major gap down. Then we hit the bottom really closer to about 2,200 on the S&P. We started climbing out. We really were expecting with a COVID outbreak or an additional spike, which really didn't happen like we thought it might, or the experts thought it might, in conjunction with a earnings season that wasn't going to look very good, that might have been the start of the W, but clearly it did not happen. Again, as stimulus packages keep coming in, it just keeps propping up the market. We blew past that gap down. We're running very close to the top of the market back in February. So we'll see what happens. The great thing is, though, is our clients, virtually everybody is back to even prior to the S&P getting back to even. And that's in part by the strategies that have been employed so far.